Hello, everyone, and welcome back to the Direct Insurance Podcast, otherwise known as DIP, a podcast for independent insurance agents brought to you by Insurance Advisors Direct, a full service FMO. I'm your host. My name is Kelsey. I am the digital marketing assistant for IAD as well as the social media strategist. And today I have a very special guest, IAD's industry partner from Retirable, Nick Mancuso. Hi, Nick. How are you?
Hi, it's nice to be here today.
Good. It was good to have you. So tell me a little bit about yourself.
Sure. So my name is Nicholas Mancuso. I'm the Director of Sales here at Retirable. We are fiduciary financial advisors specializing in the decumulation space of retirees. So how do we build holistic plans, understand where our money needs to work for us? How do we generate and maximize our income in retirement, mitigate taxes, make sure we don't run out, and then structure our investments and our strategies in a way to make sure that we're getting the most out of the retirement that we've worked so long to save for.
Yes, I agree. We've actually been talking a lot this month about retirement and annuities because June is Annuity Awareness Month. So I think that it's really important for people to understand the importance behind saving for retirement, but also how the current state of the market is really impacting investment accounts such as like 401k accounts. I tell you, my mom has complained up and down about how her 401k has lost so much money over the course of the last like 2 or 3 years. So I think that's something that we kind of want to put into a great frame of mindset for our listeners out there to kind of help teach them to combat the objections that they might get from a new client or just even current clients about why they should invest or put money into a certain type of account just based on whatever the state of the market is. So let's go ahead and dip into some insurance. So Nick, go ahead and tell me, what is the current state of the financial market in the US and why are we on a downward trend?
Yeah, so I'm not necessarily sure we're on a downward trend, right? But the current state of the market, COVID definitely happened. I don't think there's any doubt there. And what's happened because of it is we had some high inflation come out of there. We had some businesses shut down in order to kind of compete with the inflation that occurred after COVID. The Federal Reserve has risen interest rates pretty significantly and pretty aggressively. Now, rising interest rates can have a negative impact on the market, right? So when you look at long-term bonds, those values can fall. In rising interest rates, bonds function like the tail of a dog. The further away from the dog it is, the more it wags. So as bonds interest rates rise, the tail of the dog goes down and those bond values go down. So people are losing money in their bonds. The same thing happens to equity. So companies who are used to a free-flowing money exchange where they can borrow, now borrowing money becomes more expensive, meaning they're tightening their wallet, they're increasing their war chest, and they're going in here and saying, all right, time to streamline, which is why we're seeing layoffs and other things like that happen. So really, companies are protecting their balance sheets here, bonds are suffering, and pretty much in 2022, we saw an overall downward trend in the market. Now in 2023, things are starting to come back. I think the Federal Reserve is starting to slow down on the hiking of those interest rates and potentially even pausing, as we've seen it be somewhat effective at lowering these rates, albeit not as effective as we'd hoped. So there's still a chance of recession. We're hoping for a soft landing here, but ultimately the economy is moving. And this isn't necessarily unheard of. Markets are cyclical. They go through phases of expansion and recession, and they move back and forth. And it's to be expected that we're going to have corrections like this, that we're going to have these kind of recession or these regressions inside of the expansionary market of the economy. So we're in that zone right now. Ultimately, these recessions, these bear markets are typically shorter than the bull market counterparts. So whereas once this ends, we'll start to see things level off at the bottom and then expand again. And that's what we're kind of waiting for. But really, when we think about the products that we're selling or investment planning and financial planning in general, it's a good idea to take a big step back from what's currently happening and focus on long term.
Yeah.
So whether it's annuities, whether it's investments, whether it's insurance, really what we're looking out for is the next 20 to 30 years and making sure that we're on target and not just in the moment. Because if we live in the moment, we're really letting fear and emotions dictate our decisions, and that might not be the best thing for us.
Yeah, I agree. I think that there are a lot of people that will make a lot of decisions, whether it be in their personal life or in their financial life, based on how they're feeling in that moment. But it really is important, like you said, to take a step back and kind of get a good holistic picture of the cyclicalness is that a word? The
Cyclical
cycle.
nature. Yeah.
The cyclical nature of the market and just how it goes through the ebbs and flows and kind of just like having to trust the process, which can be extremely daunting at sometimes. But let's go ahead and talk about a couple base level definitions. So explain for me and the audience fixed indexed versus non-indexed accounts.
Sure. So, right, the different accounts we have. So, a fixed index might be an account or an annuity or some type of product that has a fixed interest rate, and then there's a participation rate within an index. So, let's say the S&P 500. The S&P 500 can go up and down. Usually, a fixed index product will protect you on the downside, but put a cap on the upside to give you a more even, streamlined, kind of consistent rate of return, or hopefully a consistent rate of return on there. Now, there's a fixed portion that it can't go beneath. There might be a portion of that annuity or product that is in a fixed interest rate, which might even be higher right now due to the rising rates of the Federal Reserve. So they're like the fixed portions actually might be more attractive in the current moment than an actual index version, but the index version will allow participation in the market if it goes above. Now, there are non-index products which are completely fixed, right? And we could say, hey, currently we're getting 5% per year locked in for the life of this policy. Let's go in there on a completely fixed annuity. And there could be pure variable plays where there is no fixed portion. We are subject to market movement and what's going on there. And all of these products, if we're talking about annuities in general, can also have income riders that can give you a guaranteed rate of increase on the amount that actually accrues in value or the income value of that annuity, not necessarily a general account, but something that can grow that you can pull on a certain percentage throughout your life. So there's a barrier there that you don't have to worry about participation rates in the market. All in all, there's a couple of different account types that you can have here. And what we really want to do is find out what is most appropriate for that consumer and their risk tolerance.
Yes, I think that that is something that is really important to note is just the differences between the two different types of accounts. Because with your fixed index annuity, if the market dips, your money doesn't dip with it, that you kind of just end up staying kind of like flatline until the market starts to kind of like go back up. And then with the interest will start to kind of grow again. So that's very important to note. And let's move on to some other definitions here. I know that these are obviously two very different products, but tell us what the difference is between an annuity and an IUL.
Great. All right. So both insurance products, and IUL is really it's life insurance product, right? So this is something that we're going to put money into, and the real purpose of an IUL is if I pass away, my beneficiaries will receive a large payout. And it's a large portion of leverage based off of my premiums for that payout. And the earlier that I pass away, the more they get. Think of it like a seatbelt, right? The reason why I'm purchasing a life insurance policy isn't because I'm expecting to pass away. It's in case I do. So same way I put on a seatbelt, not because I'm expecting to get into a car accident, but it's in case I do. And now an IUL has a cash value component in there that can also grow. So maybe an IUL it's indexed based on these indices like the S&P 500, where the cash value that accrues inside of the policy can grow based on that index as well. And I could potentially borrow on that money in later years if I haven't used the leverage on the life insurance policy to pay out. An annuity, on the other side, isn't designed to create legacy, really. I mean, you can use it for that purpose if you're designing it correctly, but really an annuity is designed to create an income stream that you can't outlive. So for somebody who might have a very long life expectancy, an annuity can provide a steady income throughout their retirement years that they're never going to run out of. Think of it as creating your own pension. Now, annuities have their pros and they have their cons, right? They can have a little bit higher fees, but they can also provide stability that the market cannot. And the important thing is to determine where that balance lies and how much income that client needs throughout their retirement. But for somebody with a lot of longevity inside of their plan, annuities can be a really valuable part of a holistic, balanced approach.
Yes, and there are also fixed index annuities as well as non-indexed annuity accounts too, correct?
Correct. So you can do a fixed indexed annuity, you can do a fixed annuity, you can do a variable annuity. There are different terms for annuity payouts, such as 5, 10-year fixed terms. We have SPIAs, which stands for single premium immediate annuities. And you also have deferred annuities where we can contribute to these things over time and they slowly build and build like a retirement fund or a pension. So annuities have a broad spectrum of where they can be used and what it's good for. And it really determines the first determination of an annuity is A, do they need this income stream? And B, because annuities can tend to lock things up a little bit, do they have enough liquidity outside of this to make sure that this is something that's going to stick long term?
One of the things that I think is really important to note is that although an annuity at the base level of it, or like from at least from a bird's eye view, looks very similar on the outside to a 401k account. However, at the same time, they're also very drastically different. Can you kind of explain what the differences are between a 401k account and then an annuity?
Sure. So a 401k is considered a qualified account. And by qualified, it means it's either tax deferred. If we have a basis, it could be tax free if it's like a Roth 401k or something. But an annuity is not technically qualified unless we use a qualified annuity. So an annuities can be non-qualified, meaning it's like a taxable account. The nice thing about annuities is even though it's a taxable account, it's tax deferred in terms of its growth until I take withdrawals. So they're similar in that fashion. But at 401k, typically you don't want to touch it until you're 59 and a half. Otherwise, there's a 10% penalty. The money that you put in there will grow based on the market. It's invested. There's typically a match in those 401ks that an employer will provide. You put a little bit of your money in to defer the taxes on that money later. A non-qualified annuity, you're putting after-tax dollars in, deferring the gains on that until you pull it out, but it's not lowering your tax bracket, whereas a qualified annuity can. It just depends on how we're going to fund that qualified annuity. Usually they're funded via rollovers from IRAs or 401ks when we enter retirement. So I would say the 401k is really designed for you to defer your income, lower your taxes in your working years if you're expecting to be in a lower tax bracket in retirement. The annuity is the vehicle that you can put that money or some of that money into when you're approaching retirement to turn it into an income stream and build your own pension.
I think that it's really important for people to have a 401k account and then if they can also have an annuity on top of that just because, with the state of the market and, with everything that's kind of going on and just the cost of living going up, we might think that today we have enough money saved for retirement, but then here we come in another 30, 35 years because I'm 31. So by the time that I'm 65, 66 and I'm ready to retire, what is life going to look like? What is the cost of living going to be like? So are we going to have enough money in a 401k account in order for me to like outlive, or is it going to outlive me? That's something that we really need to think about in terms of what we are going to be saving and then making the right types of choices when it comes to, so like, this is the money that I have today. This is what I want to be able to save in the next 30 to 35 years. And how is that going to impact me when taxes are going to go up in the next however many years? So how do death benefits and taxes play a role in your return on investment with the current state of the market?
Yes, I mean, so death benefits are really designed to replace lost income or assets that you would have otherwise been able to provide for your beneficiaries. And they could be a great tool for legacy building as well if we're looking for wealth transfer. Now, how do they play into like the current market situation? Well, the return if you pass away early on a life insurance policy is unparalleled, right? We're not going to beat that out in the market with like $10 or like even with like a simple term, $100 put in this month. If something happens to me in 2 months, the return is going to be in the thousands of percents return, whereas in the market might be 4 or 5%. But the thing is that life insurance policy has a cost, right? So it's not necessarily growing dollar for dollar when I put money in there, whereas the market might return a little bit faster than a conservative bucket, such as a life insurance policy. Now, life insurance policies designed correctly can be used. I've used the acronym TERI, or Tax Exempt Retirement Income, TERI, because you can actually borrow from this life insurance policy. And when the life insurance policy, if it's a whole life or permanent, when it eventually pays out, it pays off the loan that you've created from the borrow, and there's no taxes on loans. So we've created a tax-free income for us. Now, in the current market, if you're in a lower tax bracket, it might be good to defer those taxes as well. And what I would say is really get to know your client, understand what their needs are, what their current tax brackets are, and what they need to do to see if these vehicles are appropriate for them.
Yeah.
Usually, I would recommend let's maximize our qualified vehicles first. Insurance is great. We want to maximize our death benefit to make sure we have enough to cover our family if something happens. Preference is term insurance over permanent if we're looking for just the sheer number of death benefit. But if they have enough death benefit and enough capital to do this, a little bit of permanent goes a long way in terms of covering final expenses, creating another bucket that we can potentially dip into if we hit a terminal tax bracket in retirement, and we want to make sure that we pull from something that's not going to push us into the next bracket. But ultimately, we want our money to be liquid at the same time. So 401ks, IRAs, and those traditional savings vehicles should be funded before we start looking into alternatives.
There are so many of us where we want to be able to grow our money. We want to be able to have more wealth. We want to be able to have more expendable income to be able to go do the things that we want to be able to do with our lives. I personally, I'm one of those people where what's the term? Live to work or work to live. I live to work, but at the same time, I work so that I can live. I do enjoy my job. I know that there are more people out there that also enjoy their jobs, but at the same time, we also really enjoy being able to spend some time away from the office as well, and being able to spend time with friends and family and going out and exploring the world and going on trips and vacations and things like that. So we want to be able to have enough money to go do all the things that we want to do, but we also don't want to be penalized for that as well. Like we want to be rewarded for all of the hard work that we've put in and all of the money that we've saved, but without having someone telling us like, oh, well, now you make too much money. Well, guess what? Now we're going to take another however much percent of your income. So it's like, what's the point? So yeah.
Absolutely.
So actually, that kind of helps lead me into my next point here, which is the balance in financial planning. So where each type of investment option would make the most sense for a client based on their needs. So essentially, how can agents and brokers help their clients increase their assets or liquidity?
Sure. So, I mean, increasing assets is also increasing liquidity. It's just about what buckets I can pull from and where. And this is where, when we design things, we need to be conscious about what we're recommending. It's always good. I say we have three time horizons in general. You have money that you need in the next year. You have money that you need in the next 2 to 10 years, and you have money that you need in 10 years plus. Money that you need in the next year should be held in cash. We don't want market volatility to impact it. Next 2 to 10 years should be held in something stable. That's not going to fluctuate as much in the market, but still give us some growth. And then anything with a 10-year time horizon or longer can be invested for growth. Now, where we invest that money changes, right? So let's say I have a 401k and we're thinking about an annuity because we know we need a certain amount of income in retirement. I might not want to put that entire 401k inside of that because I need that liquidity in case I have to pull it. If I design that annuity in a way that it's got this income rider, I know I could pull 5% of it per year without hurting the terms of that rider and the terms of that annuity. Well, great. I've just given myself some fixed income that I can rely on, and it's very, very stable. But what happens is to your point with lifestyle before, if all of a sudden I want to buy a car and now I have to dip further into that annuity, I could penalize myself for the amount of income that I want to pull for the rest of my life because I've just upset that rider and pulled too high of a percentage. So in order to make sure that we're designing policies appropriately, we need to have and make sure that we have that other bucket of money that we can access in case we need it. So liquidity is super, super important to make sure that we're making the right recommendations if we're selling insurance products, as well as if we're selling investments on the other side, where if I'm putting your money away into something that's moderate to moderate aggressive, that if I need to pull that in the short term, I'm not capitalizing on a loss. So really the way that we design and create our buckets, the idea is don't put all your eggs in one basket. Let's make sure we have the right appropriate amount in everything. So whether it's Social Security, that's fixed income, plus an annuity on top of that might get me to about 70% fixed income throughout retirement. That's fantastic. The other 30% could be flexible, and I could choose when and when not I want to pull that. So if I have higher expenses this year, like buying a car, or the market's not doing well, I could kind of like hold off and put some guardrails around my spending in off years. Might not be the year, like 2022 might not be the year to renovate your kitchen. Let the market come back, do what we need to do, but we can flex between these different buckets that we have to make sure that we're playing optimally. And especially that allows us to play within taxes as well. Where do we take distributions from? How do we minimize and maximize? How do we minimize taxes, maximize income so that we can actually pull accordingly? So we always want a little bit of taxable investments. We always want some free money in that 401k IRA in case I need to pull it, where I'm not going to defeat the terms of that annuity. But I also like to have a little bit of fixed income coming from that annuity, which is going to give me a little bit more stability throughout retirement and allow me to place these guardrails where I need them.
Exactly. One of the things I was actually talking about this morning when I was recording a podcast episode earlier with Donald Kirkendall, where we were talking about the importance for life insurance for Gen Z and the millennial generation, and just kind of like the benefits of opening a life insurance account or having a life insurance policy early when you're young and when you're in your 20s, 30s, and early 40s. It's going to minimize your risk, or because your risk is minimized being younger, so therefore your rates and premiums are going to be a lot lower than they would be in your older years. But also just how we have to be able to educate people to mitigate the amount of money that we as people spend on things that we don't need. Myself personally, I've taken more of like a minimalistic mindset to the things that I buy, instead of just going out and being like, oh my gosh, I want this. But it's like, do I really need it though? Like, do I really need it? And thinking about how much more money would I have in my savings account if I hadn't spent however much money on unnecessary like clothes, shoes, coffee, you know? So I think a lot of that is educating our audience about what are the things that we actually need to spend our money on versus just what we want to spend our money on. But at the same time, there are lots of people that'll sit there and argue. It's like, well, if I'm just saving all my money and then if I'm not spending it, then that's going to crash the economy because I'm not going to be supporting businesses. Where I personally would say is that no, you're just spending your money in the wrong places. In my opinion, we should be supporting more small businesses like our independent agents and brokers, but also like your mom and pop coffee shops that actually pay local taxes. You're not that money's not going to like a large corporation like Starbucks, you know, where they're like a conglomerate brand, where if you're supporting more of like those small businesses, that in and of itself is going to help the economy more than if you're supporting one conglomerate because small businesses create more jobs.
Without a doubt. And I would say when you look at the money that we spend, I like to say that we use 100% of our money, right? Nobody's lighting money on fire to stay warm. And if you are, you're using it to stay warm, right? But our money fills the bucket. It's like water. So whether we're saving it, whether we're spending it, whether we're putting it towards insurance to protect ourselves, it is being used. And making sure we're using it wisely because there is a limit to how much we're going to earn in our lifetime. We just don't know it, but every dollar kind of counts. And where do we put these things to make sure that that limit, we reach that full potential, right? So when we think about life insurance, what happens if I don't meet that lifetime potential? What happens if something happens to me at 50 years old and all of a sudden my spouse, who is depending on two Social Security incomes and two people saving into their 401ks through retirement, can't get there, right? Oftentimes I say, where do we minimally want to get in terms of our life insurance death benefit and premium and face amounts? It's really, I want to make sure that I can replace my income until I got to retirement. If I can do that, my children will be taken care of, my spouse will be taken care of, right? And their retirement now looks better because they're actually able to take that life insurance proceeds, invest it in a moderate conservative way that can start to yield interest that actually will combine and replace my income. Think about 10 to 15 times your income and a term or a duration that at least gets you to retirement zone to minimally protect what you would have otherwise given them. That's a great way to kind of put your money aside and say, hey, work for me, do this thing, because if I don't earn this money, this is going to earn it for me. And really we can ensure it's such a selfless product, life insurance, where it's such a way that I make sure that my income continues to come in for my loved ones, especially for Gen Z and millennials who are at the zone where they're starting to move into family planning and working and all these things. We definitely want to put a little bucket of there in protection. Again, seatbelt analogy, you put it on hoping that you don't need to use it. But if you need to use it, you're definitely glad that you have it there.
Yeah, I agree. I like that you brought up the analogy of how long somebody would need, or I like that you brought up the math kind of behind what kind of policy you might need based on what you might make on average for every year, like you said, and you had like a 10 to 15 year analogy there. Because when you think about it, so in the state of Michigan, the average salary is about anywhere from like $60,000 to $65,000 a year. So you think, okay, even 10 years, that means that my family would need $650,000 in a life insurance policy to make up what I would be making and bringing to the table and bringing to that household and to replace that income. So $650,000 over the course of
No, it's okay.
65,000.
I mean, listen, if you're making 65,000, that's before taxes, right?
Yeah.
So your family doesn't necessarily see it anyway, and the death benefits are tax-free payouts. So what we think about is like, all right, let's take 60% or 70% of our income. So instead of 65,000, let's call it 50,000. All right. And then let's say I need to replace $50,000 a year. How much of a lump sum do I need to create growth inside of an investment account with spending down principal to yield $50,000 a year going forward? And the math typically works out somewhere between 10 to 15 times your salary. So if your salary is 65,000, 650,000 should be enough if invested appropriately once it pays out to yield a certain amount of income that combined with some withdrawals of principal in that investment account, you can now pull evenly. And also sometimes you use life insurance policies proceeds to put into an annuity because that now can replace that income for that person, or we can put it in investments if we don't necessarily need the income to get a little bit more growth, but it depends on the situation.
Yeah, I think that's really important for anybody to know as well that if they do have a parent that passes away and they had a life insurance policy, whatever, like if you're the beneficiary for that life insurance account, is that you might not need that money other than just paying for the cost of like the funerals and whatever else, especially for adult children. I'll use myself as an example because I was already an adult and 26, moved out, married in my own house by the time that my father passed away. So I didn't necessarily need to have that money in order to keep myself going because obviously I was already like, working. My husband was working. We could pay all our own bills. Everything was fine. But now it's about how do I take that and grow that amount of money, because at a certain point it's kind of like I love you money, and so this is what the growth opportunities that someone can have from a life insurance policy.
Yeah, and that's generational wealth that we can use to create as well. So again, it's a selfless thing. At bare minimum, we want to make sure our loved ones are covered because I'm not reaching my earning potential. I was cut short due to premature passing. But if it's not necessarily cut short and my dependents are older and grown, now I'm creating generational wealth for them. So it's a head start for my children. It's a head start for my family, or it's replacing the income that I would have pulled in retirement for my spouse, because we're going to lose that Social Security for the household. They get the greater of the two. Or we're going to lose the contributions I would have put into that retirement account for us to live off of in our later years. Now it's only one person contributing to a retirement account. So where we use the money can come from different places, but there's always a place that we can use it. Again, use 100% of the money that you have coming in, whether it's for saving or spending.
Exactly. And I think that actually kind of ties into my next question here for you as well, which is based on your industry knowledge and research, how do you think that today's financial decisions will impact the future of investing? And I think this kind of like ties in because when we were talking about generational wealth, how is it that this is going to impact how future generations, if everyone had life insurance and everyone had more than enough money to pass down to their children and for them to create generational wealth, how do you think that this is going to impact how future generations are going to look at insurance products in terms of saving for their own retirement, as opposed to just, oh, look, now I have all this money. Now I guess I can go on that vacation to Cabo that I always wanted to take, which I mean, go ahead and do that too, but still.
Yeah, I mean, we're coming up on the biggest wealth transfer, generational wealth transfer in history, right? When you look at who owns most of the assets right now, it's the older generation. And as they kind of pass away and they transfer their wealth, it's moving to their children, it's moving down the stream. Now, a lot of people are using this to supplement their income and do things with but a lot of it's not necessarily liquid. We're talking properties and things that need to be sold, or actually things that cost money to maintain, because now we're paying taxes and doing things like that. Now, the decisions that we make today are absolutely impacting our future. The best time to put together a financial plan and start investing is yesterday. You don't get any younger. Premiums for insurance don't get any cheaper. You have compounding interest on your investments and the growth that you have. So sooner is definitely better. Now, the things that we want to do is make sure that we lock in good rates if we need insurance. We want to make sure that if interest rates are high and we're looking at annuity, maybe a fixed option might be great. Leave some liquidity to the side because there's opportunity cost to locking everything up. It's really important to speak to an advisor and really get that holistic advice of how everything works together, because it's all connected, right? The premiums that you're putting towards life insurance policy might not go towards retirement. The money that you're putting towards retirement might not be there to protect you in case you can't contribute to retirement 3 years down the line from now because you're not here. So we really want to make sure we have the appropriate mix of everything. That balance today will give you balance in retirement. And really, that's, I think, what we're all looking forward to. Listen, I live to work, but at some point, I don't want to do it anymore. I want to retire and go sit in a hot tub in my backyard and watch sports all day. And like, that's my dream. And like, I want to get there. And there's only one way that I'm going to do it. And it's going to be by planning for it. It's not going to happen by accident.
Yeah. One of the things that you brought up that I thought was very interesting was we were talking about balance and connection. So how is it that the balance of life insurance and annuities and just other types of insurance products, how does the balance of these products have in relation, how does it connect in relation to the state of the market? And how can these things impact each other or if they don't impact each other at all.
Oh, they could have a massive impact on each other. So, right, an annuity can help weather a storm, especially as we're starting to pull income. I have a set amount. I don't have to worry about capitalizing on losses in the market because if I have like income riders or certain things on my annuity, I'm getting a fixed amount of income every single year. Now, inflation can adjust that and make it feel like less. COLA riders are quite important. We might want to add those on, especially as we're selling annuities that are going to yield income, because that's going to allow us to make sure that we're feeling comfortable and it feels the same over time. But at the same portion, the money that I have put in an annuity, if I need that money to do something and it's not there, or it's locked up and I'm going to hurt myself long term, well, now I've just put too much eggs in one basket and it's not even. I need an investment on the other side, right? And then if I have too much investment on the other side and the market goes down, well, now I may have to cut my lifestyle down because I don't want to pull too much at a low market. I need to allow it to come back. So now I don't have the fixed income to get me through some hard times, and I'm left with a tough choice to either pull my money out and capitalize this loss or significantly reduce my lifestyle. In some cases, I don't have that option because it's going towards essential expenses like housing and debt and taxes and healthcare being the one of the most important.
Yes,
So
absolutely.
so what I want to do here is understand where that balance lies and work with the center of influences that can give you all those things. So by working with an investment advisor as a partner, so like Retirable partners with IAD to do this for them, this is a really valuable aspect where we can make sure that we have the appropriate balance of here's how much we think we're going to put into an annuity, here's how much fixed income we expect between the annuity or pension we've created plus Social Security, here's our variable income. We know that our essentials are covered by our fixed, so we never have to go without, and we're not going to spiral out with debt or anything like that. Our lifestyle is somewhat variable because we want a little bit more growth in these normal investment vehicles. Because to be fair, a normal investment vehicle will give you more growth over a long period of time. But if we have to capitalize on short-term losses and things like that, it can go down to a sequence of returns change. And the balance between those allows me to maximize where I pull from and when, how do I place my guardrails, and how do I make sure that I'm going in with the most confidence and security possible.
Yeah. Speaking of variability in lifestyle, one of the things that it kind of came to my mind as you were talking about that was back in a couple years ago when I was working in retail and the stimulus checks would come in. Oh my goodness, we would get so crazy busy. I mean, everybody would come in and spend like hundreds of dollars on stuff that in reality, in my opinion, they just didn't need. But that's kind of what ends up happening is that when people do come into these large sums of money that either they weren't expecting or that they hadn't maybe necessarily worked for, they tend to put it into the wrong places. A lot of talk that I've seen online on social media in regards to like the stimulus checks was that people who are financially responsible, what they were doing with that money was they were putting these into the different investments accounts like IULs and annuity accounts so that they could create either generational wealth for themselves or for a retirement plan for when they're older. Whereas people who were less financially responsible and maybe not as educated on how to be financially responsible, these were the people that were just dropping all kinds of money at whatever different like retail stores that they could get their hands on because people want to feel a certain sense of importance in themselves and feeling like they are wealthy when in general they don't have the type of wealth that they want. Like they want to live this lavish lifestyle of feeling like they have all this money when in reality it's like you would have more money if you just hadn't spent it. I think there is kind of like an age old saying that wealthy people maintain their wealth because they don't spend it, whereas obviously unwealthy people are stay unwealthy because they continue to spend their money. So how do you think that agents and brokers can help educate people in their communities, whether they are a client or not? How do you think that brokers can use what they know and educate communities on how to be more financially responsible in their younger years so that then when they get to a certain age where they really need to start thinking about life insurance, annuities, retirement, and taxes, and how all of this is going to impact their future as a retired adult, what are some resources that you can think of that can help agents or brokers educate their clients on the importance of being financially responsible and investing early?
Yeah, I mean, well, retirement is not something you think about when you turn 50. It's something that you think about immediately when you start working. The earlier and more you put away, the less it becomes a concern, right? And what happens is if you don't do those things early, you end up running into a situation where you're 50 and now you're curbing your spend because you have to put this money away because you're under a deadline, right? And like when you think about, I would say like let's look at the psychology behind somebody, and I would compare it to a diet with no cake, right? Even a diet needs a little bit of a cheat day. So for example, I love to golf. If I listen to the math behind financial advice, I would not do it. It's quite expensive and I'm very bad at it. So it's just like an exercise in spending money and being bad at a sport, but it makes me happy. If you're a financial advisor and you're recommending products and you're robbing somebody of that to do these things, even if it's financially responsible, you're not going to be met with a positive response there, right? We have to understand the psychology behind who we're selling and what they want to do and kind of understand that there's going to be a little ebb and flow here. You can't recommend that's something that's going to lock everything up for them because they're going to abandon it. Like your persistence rate and your persistency is going to suffer because people don't necessarily go through with these plans. And like a diet without any cake, you're going to end up cheating on that diet way worse than you would have if you had a little cheat day every Sunday or a little tiny sliver of cake every once a week, right? And then you end up falling off the wagon and it goes to the wayside. So a financial plan needs that personalized balance as well, not just the balance between what accounts we choose, but like the ability to spend some now and maintain your life while you're enjoying it, but also make sure you're conscious and putting things away for the future. So again, don't put all your eggs in one basket. Make sure a lifestyle is there. Make sure we have liquidity. Make sure you're understanding as an advisor and as an agent, what are their needs? What's important to them? What are the things that are non-negotiable that they want to be able to do? Because if I lock up that money, I'm going to lose that sale almost immediately. They're going to be like, well, I can't do this, so this doesn't make sense. Let me go find another option. Let's work around it. Let's figure out what works best for them. Because if this makes sense and they're like, yes, I love this, it's going to be hard to back away for it. But if you tell somebody that, I'm sorry, you can never go out to eat again, but you'll have a life insurance policy here for you. Well, then what's the point of life insurance policy? I want to live my life now. And you're going to get that response as well. So balance on the psychological side between who we're selling is really important. Is some of that spending irresponsible? Maybe. Does it make somebody happy? And is that something that they kind of want in their life once in a while? Absolutely. Go on vacation once in a while. Life is meant to be lived. You only get one shot at it. And we have to be somewhat understanding of both aspects of the aisle. And by the
Absolutely.
way, when it comes to the stimulus checks, people did exactly what the government hoped they did, right? Let's throw it back into the economy and make sure we're spending it. And it might have been a nice treat for somebody to be able to spend something, especially as times are very, very tight for them, to get a little bit of that joy and a little bit of that excitement. Would it have done better if we put into an investment? No doubt. Would I have instead think about like maybe take 30% and spend it and put the rest away? Absolutely. But I think if you go one or the other, you're not in the right place. Balance is key.
Yeah, I agree. I think that balance is something that's really important. I'm going to kind of like circle back to your cake on a no cake on a diet analogy because for a short while I was working with a personal trainer and she told me that she was like the absolute worst thing that you can do is immediately try to cut out things out of your diet that you love. She was like, yes, if you love Oreos, it's okay to have some Oreos, but just make sure that you are, trying to stick to whatever other like macros and other sort of like nutrients that you want in your day or even like your calorie count for the day as well. So say for example, if you want to stay to under about 1800 calories a day, then you better make sure that you've only consumed like that 1600. So then you've got that extra 200 for that little cushion room for those Oreos and it's all about like making the plan for it. And it's the same thing with saving for retirement. You just have to make the plan for it and have that like conscious decision of that, okay, this is how much money that I make on a regular monthly income basis. So, this percentage is going to go towards all of my bills. This percentage is going to be towards like fun stuff. And then this percentage is going to go towards my retirement or whatever other like investment or savings accounts, because this is what is going to benefit not only me, but my family in the long run. And I'm also going to circle back to the point that you had made about the stimulus checks, because something that I did, what I ended up doing with mine was doing a little bit of work on my house as well. So we spent quite a bit of money at Lowe's, but I also bought my dog. So that really made me happy. So I mean, like, yeah, I guess it kind of just depends on, you got to do what makes you happy. You only get one life. And if I could buy an entire field of dogs, I would.
That'd
That
be
would make me
exciting.
happy.
Yeah, but
Yeah.
then you have cost of like feeding a field of dogs. You need a field of food.
Yeah, that's true. That's very true. And I'd have to go pick up after them a lot more often than I would have with just my one.
Exactly. You have to hire somebody to pick up after them. But yeah, again, like too much of anything, not good, right? Like saving into your 401k. Fantastic. Yes, contribute there. But if you put too much money in there and all of a sudden you have a liquidity issue and you need to be able to pull out of it, you're not 59 and a half, you're going to have a big penalty, right?
Yeah.
So you don't want to leave yourself in that position. You want to make sure you have 3 to 6 months of emergency savings. You want to make sure we're saving 20% of our income. We want to make sure that we're at least getting the match on our 401k, if not then more, ideally at least 10% contribution. And then we could start to think about, do I have enough insurance to protect my family if I can't work? Do I have all these things? But protection is really as important as the savings aspect too when it comes to life insurance. And then when we talk about protecting our income in retirement, having that fixed income, that annuity, those are important. But again, I need that liquidity. I need that flexibility on top of there. So when I think of things, break things into thirds. My income fixed, perfect. 1/3 is variable. That gives me flexibility inside of there. When I'm putting my savings away, am I putting at least 2/3 into my 401k, 1/3 into my taxable savings that I can use for liquidity? That's a fantastic idea. And that's not like a rule of thumb or anything, but it's a good starting place for you to figure out that, hey, I do have some level of balance inside of this plan.
Yeah. Speaking of ideas, can you give me 3 ideas or 3 tips that agents or brokers can use in order to take this information that we've been talking about today, or any tidbits of or nuggets of knowledge, if you will, and how can they apply it to their business and help their clients in understanding the importance of how much to save based on what their income is like and what kind of tax bracket that they want to be in when they retire?
Yeah, I think it comes down to understanding their financial plan and what's comfortable for them, right? Holistic financial planning is super important. In fact, 72% of Americans do not have a financial plan. They might have an advisor, they might have an insurance broker, but nobody is really sitting down with the majority of Americans and saying, here's how everything works together. Here's how your Social Security impacts your fixed income. How much do you need to supplement that? How much do we need to pull from variable? When should we take Social Security? How much should we be saving? Where should we be saving it? Should we be saving versus paying off debt? What should we be doing here? That level of financial planning is really, really important. And that's why Retirable, we are fiduciary financial advisors, and that's where we focus. And we don't sell any commission-based products, no insurances, no nothing like that, because we don't want to overlap with the people who we're working with in our center of influence. But really making an introduction to a financial advisor can help you solidify your own products, because it's hard to sell these long-term products like life insurance and annuities without a financial plan. And really what I would say for somebody starting out is understand how the product works, and understand that you are here to do the right thing by your client and what's in their best interest. How does this benefit them? And where are you providing some level of flexibility? That's going to breed a massive amount of trust for that client. And the more a client trusts you, the more they're going to come back, the more they're willing to buy from you, and the more you get to sleep easy at night knowing that you made the right recommendation there. So get to know your client, understand what their goals are, understand what's really, really important to them. How do we get them across this line and provide them that financial balance? And then potentially, how do we partner such as Retirable and IAD to make sure we cover any gaps that we have in our plan and make sure that they have a full center of influence? The goodwill that you can get as an advisor or an agent from connecting somebody with that center of influence is monumental, and that can increase your practice as well.
Oh, absolutely. And I think that that is something to really touch on as well, is just that as an agent or broker, you can be specialized in a certain area. Like, for example, here at IAD, we have our life products, annuities products, as well as Medicare. But, you could be an agent or a broker that has, a broad product portfolio where you have all three. But on the flip side of the same coin, you can be a jack of all trades, but master of none. So it's important for agents and brokers to partner with places like Retirable in order to help break down that process just one step further. And again, develop a better relationship of trust and rapport with that client. Because when the client feels truly educated and they don't feel sold, and they feel like, okay, now I've been given all the information that's important for me, I can make this decision myself. And you're kind of just like filling out the enrollment application for me, which is, in and of itself great. So it's important for agents to have these other entities and partnerships in order to give their clients the full bird's eye view, so that then they can be fully educated and make their own financial decisions. Because once they've been given all the cards, they can kind of just decide which ones they want to play.
Yeah, I would say, and I say this to the advisors that work here too, clients don't like to change their mind, but they're willing to make new decisions based on new information. And really what it means is that you might have the right thing for that client. What's missing here is that they don't understand why it's that good fit. It's lead with more education. Every objection is a request for more information. And sometimes the more educated the client is, the easier that client is to work with because they understand what you do. So educate yourself on these products, understand how they work, and then you can explain these concepts to your clients instead of just selling them the product and saying, this is what you need. Do this, trust me on it. Here's how this works. Here's how it's going to benefit you. And that's going to increase your sales and increase your client satisfaction as well.
Oh, absolutely. Okay. Well, Nick, my last question for you is what are your top 3 tips or what is your best advice for our listeners out there?
Best advice, financial planning first and early. A holistic plan allows you to maximize really what you're doing. It's like building the picture on a puzzle box. That's how you know where to move around the pieces. If you had no picture, it's hard to build that puzzle. Second, saving and investing early on is super, super important. Don't overlook the impact of compounding interest. It is huge and makes a material difference in retirement. Don't put it off, do it early. And then 3, financial planning is all about balance. Let's make sure that we have the right things in the right buckets. Don't put all your eggs in one basket. Have your taxable account, have your liquid account that's invested normally, have your fixed income and your annuities and your protection in place, have your social security plan in there. A balanced portfolio will weather the storm much better than something that's top heavy or bottom heavy.
Wow. Nick, thank you so much for all of that advice for our listeners. Wow, that's awesome. And you actually did quite a good recap of the things we talked about. So I feel like I really don't even need to do a recap. But so if people want to get in touch with you, where can they do that or how can they do that?
Yeah, I mean, so I would say if you can reach us at retirable.com. You can always email us at advisor@retirable.com and one of our advisors will reach out. But if you're an agent of IADs, we have a partnership going. So you can reach me at partnerships@retirable.com. We can get you set up and make sure that you have access to the partnership that we have going. We can help monetize the conversations that you're having around annuities and the balance that you're bringing. So if you're selling annuities, you're selling these other products, and there's money that's being left on the table because we want these investments to stay liquid. How do we monetize that for your agents? We can absolutely help partner with Retirable. We'll work out a referral for you and get some compensation your way to help monetize those things, especially for agents who are starting out where this is a little bit more of a product to sell, whereas Retirable is an introduction to make. It's a little bit easier a conversation to have. Yeah, so get in touch with me at partnerships@retirable.com or nick@retirable.com, and I'd love to get you set up. As said, Retirable has a partnership with IAD. We'd love to expand on that and help to provide balance to all of your clients.
Awesome. Awesome. Well, Nick, thank you so much. Thank you so much for joining me on today's episode of the Direct Insurance Podcast. I hope everyone out there listening learned something new today because I know I did. To view this podcast after it airs, you can watch it over on the Insurance Advisors Direct YouTube channel. And speaking of YouTube, you can follow Insurance Advisors Direct on social media. We are on Facebook, LinkedIn, YouTube, and TikTok. And if you are an independent agent or thinking of becoming an independent agent and you are looking for an industry partner, we here at IAD would love to be considered. And if you want to learn more about IAD, you can visit our website, www.iadbrokerage.com, or you can call us toll free at 1-800-381-0977. Thank you so much again, Nick, for joining me today. It was lovely having you. I loved our conversation, and I look forward to hearing from you again soon.
Me too. Pleasure was all mine. Thank you.
Awesome. Bye.